Confused about stocks, ETFs, and index funds? You're not alone. By the end of this video, you'll know exactly what each is, how they work, and which one might be right for you. If you want simple, practical investing advice without the hype, you're in the right place. We're here to cut through the jargon and give you clear, actionable information so you can start building wealth with confidence. This isn't about get-rich-quick schemes. It's about understanding the tools at your disposal to make smart, informed decisions for your financial future. So, let's get started and demystify these core components of the investing world. Let's begin with the most well-known of the three, stocks. A stock is basically a small piece of ownership in a company. When you hear about people buying shares on the stock market, this is what they're talking about. It's like buying a tiny slice of a very large pizza. For example, if you buy shares of Apple or Tesla, you literally own a tiny fraction of that company. You become a part owner, and your fortune is now tied to the success or failure of that single business. If the company does well, makes great products, and increases its profits, the value of your shares can go up, sometimes dramatically. This brings us to the main pro of owning individual stocks, the potential for high returns. If you pick the right company at the right time, think of buying Amazon or Netflix in their early days, your investment could multiply many times over. The upside can be huge. Another potential benefit is that owning certain types of stock can give you voting rights in the company, allowing you to have a say in major corporate decisions, like electing the board of directors. However, this high reward potential comes with a significant downside: higher risk. The value of a single stock can swing wildly based on a company's performance, industry news, or even a single tweet. One bad earnings report or a product recall can cause the price of your stock to plummet. Picking individual stocks requires a lot of research, a strong stomach for volatility, and the willingness to accept that you could lose a substantial portion, or even all, of your investment in that one company. For this reason, buying individual stocks is best for people who genuinely enjoy digging into company financial statements, who want to handpick the businesses they invest in, and who can handle the emotional rollercoaster that comes with high-risk, high-reward investing. Next up, let's talk about ETFs, which stands for Exchange-Traded Fund. Think of an ETF as a basket that holds a bunch of different investments, like stocks, bonds, or commodities, all bundled together into one convenient package. This basket then trades on a stock exchange just like a single stock, meaning you can buy and sell it throughout the trading day. The most common type of ETF is one that tracks a stock market index. For instance, an S&P 500 ETF doesn't just invest in one company. It holds shares in all 500 of the top US companies included in the S&P 500 index. So, by buying just one share of that ETF, you instantly gain exposure to a wide array of major businesses like Apple, Microsoft, Amazon, and hundreds of others. The biggest advantage of an ETF is instant diversification. Instead of putting all your eggs in one basket by buying a single stock, you're spreading your investment across hundreds or even thousands of companies. This significantly lowers your risk compared to owning just one or two stocks. If one company in the fund has a bad quarter, its poor performance is buffered by the success of the other 499 companies. Another pro is their flexibility. Because they trade like stocks, you can buy or sell them at any point during market hours, and their prices fluctuate in real time. This makes them very accessible and easy to manage. However, ETFs are not without their cons. They come with management fees, known as the expense ratio, which is the cost of running the fund. While these fees are typically very low for broad market ETFs, they still exist. Also, because an ETF holds a broad collection of stocks, you are still exposed to overall market dips. If the entire stock market goes down, the value of your ETF will go down with it. ETFs are an excellent choice for beginners who want a simple, diversified starting point, or for any investor who wants broad market exposure without the headache and risk of picking individual stocks. Finally, let's look at index funds. An index fund is a type of mutual fund specifically designed to track a particular market index, like the S&P 500 or the NASDAQ 100. Its goal isn't to beat the market, but to match the market's performance. Just like an S&P 500 ETF, buying an S&P 500 index fund means you are automatically investing your money across the 500 largest publicly traded companies in the United States. You get the same broad diversification and exposure. So, what's the difference between an index fund and an ETF that tracks the same index? The key distinctions are in how they are traded and their cost structure. While ETFs trade like stocks throughout the day, index funds are typically bought and sold directly through a brokerage and only trade once per day. at the price calculated at the end of the trading day. This makes them less flexible for active traders but perfectly suitable for long-term investors. The main pro of index funds is that they often have the absolute lowest fees, sometimes even lower than their ETF counterparts. Because they are passively managed, simply tracking an index rather than having a fund manager actively picking stocks, their operating costs are minimal. This simple, low-cost structure makes them an incredibly powerful tool for long-term wealth building. The main con is their lack of intraday trading. You can't buy at 10 a.m. and sell at 2 p.m. to capture a small price swing. You place your order, and it gets executed at the closing price. Index funds are perfect for long-term, set-it-and-forget-it investors who want to steadily grow their wealth over decades with minimal effort and the lowest possible costs. Now, let's put it all together in a direct comparison. Imagine you have $1,000 to invest. With that $1,000, you could buy shares of a single stock, like Apple. If Apple has a fantastic year, your $1,000 could grow significantly. But if it faces unexpected challenges, your investment could shrink just as fast. This is the high-risk, high-reward path. Alternatively, you could use that $1,000 to buy shares of an S&P 500 ETF. Now, your money is spread across 500 different companies. You get moderate risk and the potential for steady, market-based growth, with the flexibility to trade your shares whenever the market is open. Finally, you could invest that $1,000 into an S&P 500 index fund. You get the exact same diversification as the ETF, but it's a simpler, buy-and-hold process that often comes with the lowest fees. This is the path for the ultimate long-term, passive investor. In a nutshell, stocks are for high-risk, high-reward stock pickers. ETFs offer moderate risk, diversification, and trading flexibility. Index funds provide moderate risk, ultimate simplicity, and typically the lowest costs for long-term growth. For most people just starting their investing journey, ETFs or index funds are the smart, low-stress choice. Now you know the difference between stocks, ETFs, and index funds. Which one fits your investing style? There's no single right answer for everyone. The best choice depends on your personal financial goals, your risk tolerance, and how hands-on you want to be with your portfolio. The key is to understand these tools so you can use them effectively to build the future you want. Comment below if you want me to make a video on the best ETFs for beginners in 2025. Your feedback helps me create the content that you find most valuable on your financial journey. If you found this helpful, hit subscribe and turn on notifications so you never miss a practical investing tip. We are committed to bringing you clear, straightforward advice every week to help you invest smarter.